What's going on, guys? Hamilton here with the Trading Initiative with yet another swing trading idea. The previous video that we put out, if you haven't watched it yet, feel free. The setup is very similar. That was on ticker Z. Zillow, yes, the real estate / internet related company. Today's ticker is UA or UAA, Under Armour. Generally the same setup. We're going to go through some of the stuff that we look at through the TTI trading system, kind of build this expectancy of what we can reasonably assume is going to happen throughout this trade idea, target what we're going to target on the options chain, and hopefully this gets the wheels spinning and potentially you might even want to take this trade. So without further ado, let's get into it. Just like Zillow, Under Armour rather, an aggressive sell-off starting back in 2021, right? So from 2021 all the way through 2022, we sold off to its very low 75-ish%. But realistically, we're going to start our horizontal channel that we start forming, even though we did form a rounded bottom on this big gap down in May of 2022. This sets the stage for where we're attempting to buy the breakout today, so this matters to us. So we get this huge gap down in the middle of May of last year, and then we have essentially, if we go ahead and shift click and drag over, essentially almost, I don't know, half to 3/4 of a year of consolidation underneath the $10 area. As you can see, the $10 area was rejected a few times in the beginning. Then we get this nice rounded bottom, which generally is assumed to be an accumulation pattern. And here we are once again testing that $10 area. Therefore, we are looking at the $10 area as a potential risk on area for this trade idea. This is the horizontal level that we are targeting and that we will be utilizing moving forward. So we want to go ahead and verify that we're in some sort of bullish momentum regime, and we are. Starting back in the beginning of November, we broke above the 50 within the RSI. We oscillated between the 50 and the 70, came down and tested the 70 during a consolidation period, bounced off of the 50, and we're heading up north of 70. This is, all intents and purposes, a bullish momentum regime within the TTI trading system. This is damn near perfect when it comes to what we're looking for with RSI. We want to see the 50 hold during at least one oscillation to confirm the bullish momentum regime. And as always, RSI has to be above the 50 to even think about going long to begin with. So RSI is telling us, hey, bullish momentum regime. We have a horizontal level that is potentially breaking out today above that $10 area. We're trading above the 200-day moving average. This is an essential piece of pretty much everything that we've been longing over the last 8 to 12 weeks. We don't want to be longing anything that's underneath this 200-day moving average because we already have some names, actually a lot of the market, over 60% of the market, is trading above the 200-day moving average. Why would we want to take subpar setups that haven't even made it back to the 200 when we already have an overwhelmingly large majority of the market trading above? So it does pass that prereq that we've instituted over the last 8 to 12 weeks above the 200-day moving average. We are going to knock at one point, though. I want you to think about it. We're above the 200-day moving average, and this, for all intents and purposes, by the end of what we're looking at, could be an A setup. I'm actually going to knock this back down to either a B or a B plus setup from a potential A setup. And the reason why, this 200-day moving average. We, in a perfect world, would want to see it sloped horizontally right now, or potentially even sloped to the upside. Why? Because as the 200-day starts to flatten out and slope to the upside, these breakouts tend to stick. The probability of these things continuing up is just maximized when the 200-day moving average has had enough time to flatline and start curtailing to the upside. So we are early in terms of the 200-day moving average catching up to price, but we are trading north of it, so we will give it the green light, just not as green of a light if there's a varying degree of green lights there. So once again, from an A setup probably to a high B, B plus setup. All right, we're going to look at the ADR and confirm that it's above 3, and it is. It's 3.79. We do not take trades in TTI with under 3 ADR. If you don't know what ADR is, we are always looking for 3 or more. This is your average daily range. This is the distance from the peak to trough intraday on average. We also like to use ATR to get a general idea for expectations of moves. ATR is denoted in dollar amounts. ADR is in percentages. Reason why we like to set these thresholds relatively high, because you're going to find tickers that are under 3, is that as traders, you need volatility to make money, right? Specifically as options traders, you need something moving, otherwise the contract premium is just going to get eaten away by theta, right? So if you're trading something with like a 1.5% ADR and this thing consolidates for 6, 7, 8 sessions in a row, which totally happens for these low ADR sorts of plays, what happens to your premium during that time? get chopped up and you eventually lose a bunch of whatever is originally on that premium and you start in a hole once you get the actual breakouts. We're going to go ahead and delete that. We're above the 380R, so that's a green light. We're above the horizontal level break, green light. We're above the 200-day moving average, green light. RSI bullish momentum regime, green light. So far, we're hitting home runs back to back to back to back. And what really makes this stand out to me is obviously it's a gap setup, right? Everybody is going to be looking to fill this gap. But what I like is this low volume node coming in from about $10 all the way up to about $13.50. This is a low volume node. And this is something that we have been noticing for the last year on the way down, and now we're going to start noticing it on the way back up, assuming these things are actually consolidating and starting to break back to the upside in some primary uptrends. These low volume node areas, there's no volume on the way down, right? There's very little volume going to be on the way up to essentially sell into, right? People are not going to be looking to defend any previous support trend resistance spots because there is none. There's no sell volume through this price gap rather. And so what can we assume on a break above and into this low volume node? We can assume that there's going to be very little resistance through this zone. So we would expect a more than usual volatile breakout, if you will, just an easier path to the upside until we eventually hit that previous support, now turned resistance at around 13.5. Okay, so this really gives us some conviction on this breakout. And like I said, we've noticed this in the past over the last year on the way down. We've shorted some great opportunities like AMD, Tesla, etc. that had these low volume nodes to the downside. Same concept applies to the upside. If there's very little volume on the downside, there's going to be very little volume on the upside to sell into, and so we would expect Under Armour to just glide right through this area. Okay, so let's talk about entry, stop, and take profit before we hop into the options chain. Obviously, $10 is going to be our risk, but we did break above that today. So what do we do if, for example, you haven't already got long? Well, as of today, if you look at the RVOL, we did close at 1.22. Why is that significant? That is significant because anything over 1 RVOL on the daily time frame, which we're at, right? We have the daily time frame. We have a previous resistance area that we're breaking. Call that the horizontal level. 66% of the time, we get a pullback in towards that horizontal level over the next 1 to 2 trading sessions. So what can we expect either tomorrow or Thursday? With Under Armour, a pullback down towards the $10 area, potentially even slightly below it. So if you haven't already gotten long Under Armour, I would look to wait for a pullback to get long around the $10 area. This gives you 2 distinct advantages. By the way, this is called our BRB setup. We utilize this all the time. It's our highest risk to reward setup. This is our bread and butter within the trading initiative. So you're learning it for free. I hope this helps. Listen, there's a 2-pronged attack here on buying the pullback in towards the original $10 level. One, you get cheaper discounted, or cheaper contracts rather, if you're trading options. Typically, when you get a pullback after a huge IV pop, you get IV crushed. Everybody that chased Under Armour up here is going to be looking to sell, thinking that this was a fake out, and you're going to be looking at getting those original contracts that they bought from here for about 50% discount. That is incredible. That can maximize your potential reward because it's the same idea, targeting the 13.5 area while taking the $10 risk on area as your entry mechanism. You're buying the pullback into the same original area that the first person bought the breakout of, but you're buying their contracts that they're probably going to be selling for 50% off. It's an incredible bargain for you. Secondly, because you're buying those for 50% off, what happens if this trade does pull back and you get stopped out? Your original position size that probably would have cost you $50 originally now only costs you $25 because you bought on a pullback and you got a 50% discount. Let's say you just completely mismanaged the trade and you let this thing go to zero. Instead of losing $50, you are now down a maximum of $25. That's an incredible advantage, specifically over time if you institute this BRB setup time and time again. High volume breakouts across horizontal levels. You buy the pullback, you utilize the same stop as the person that was already running the breakout, right? But you're getting a cheaper discount, or a cheaper contract rather. I keep saying cheaper discount. A cheaper contract that you paid less for, which means your overall risk is going to be less and your maximum reward is going to be higher, right? So for our entry mechanism, $10. For our price target, we're going to be targeting somewhere up near the top of this 1.618 fib extension, somewhere around 13 to 13.5, given the low volume node. And we're really looking to close earlier than 924. Realistically, we're probably going to want to be looking to close somewhere around 950. So if you are to buy a pullback over the next 2 sessions on this United or Under Armour ticker, and you get long somewhere around $10, maybe a couple pennies below, somewhere like 955 or something, and you run this original 950 stop, your loss is going to be very, very small compared to the guy that's going to hold for the original stop that bought the breakout at like 1050. All right, so you're going to maximize reward, you're going to reduce risk, and you're going to be grabbing a discount on the way there. So what we're looking for in terms of the actual contracts, we're looking for probably buying the April 21st, 94 days till expiration. And I'm going to go ahead and show a picture right now on the screen so you can see it. And we're looking at the 12.5 calls. 12.5 calls are going to give us a distinct advantage because, one, it has a 0.27 delta, which just generally works better for swing traders. That 0.25 delta is that sweet spot, so 0.27 is right there. It's going to give us good value for every dollar this moves up. We're going to be able to obviously gain about 27 cents on the contract, and right now these contracts are going for 40 cents, so that's about a 50% move in the contract per dollar. It's pretty damn good, right? Aprils give us plenty of time to be right or wrong, 94 days till expiration, because we expect a low volume node up towards around 13 to 13.5. It should not take us anywhere near 94 days to get long and hit our price target, but the closer expirations of those February 17th only have 31 days till expiration, and that might not be enough time. So we need to find a nice balance between too much time and not enough time. The Aprils, the 12.5s are still going to be super cheap, trading right now at 40 cents for a 0.27 delta, giving you 94 days till expiration. The best part, if you wait for a pullback in towards that $10, I bet you those 12.5s are going to reprice to about 30 cents, maybe even upper 20s, which means you're essentially going to get, once again, a 50% discount on this original play. Last thing I'm going to say is you can also run shares on this. You do not need to run options. If you're an equities trader, or maybe you don't like trading options on things less than 20 bucks, which is totally okay, because it has over a 3 ADR and we're looking for, from a spot perspective, nearly a 30% move. You could play the same stop somewhere around 950, and I set this up right here to kind of show what that is. If we bring this stop down to like 950-ish, somewhere around 952, and our price target somewhere up near like 1311, you're getting a 4.28 to 1 risk to reward, which is absolutely fantastic. Most people are going to take that trade 100 out of 100 times, assuming that everything else lines up as well. So this is a great opportunity not only for an options trader, but also an equities trader. Just to back this up really quick, Under Armour is going to be considered a consumer discretionary play. We know that consumer discretionary is popping off right now, specifically the equal weighted consumer discretionary ETF RCD. This just hit 8-month highs. So don't just look at the unequal weighted consumer discretionary, which is XLY. Why? Because this is denoted by 2 main tickers. Amazon and Tesla. I can't write. And we know the performance of these has been abysmal lately. RCD is your equal weighted consumer discretionary, which has essentially an even playing field. And this just hit 8-month highs today. So we know that consumer discretionary is really actually doing well outside of Amazon and Tesla. Okay, so look for the consumer discretionary play. Obviously, Under Armour is going to be an XRT industry, which is your retail. Retail is also doing well. $10 entry, 13 to 13.5 take profit, a 950-ish stop. The 12.5 April calls are going to hit your target, or you can just buy equities. All right. This is how we operate. We know exactly what we're trading. We know exactly where our entries, our stops, our take profits are. We know why we're long, right? We know why we're interested. We know that consumer discretionary and the industry itself is doing very well. We know how to get long. This is exactly what we do. And the best part, you only have to be online for about 2 minutes to execute the trade, and then you can go do whatever you want. So listen, guys, pitch at the last minute here. If you work a 9 to 5, if you're busy, you have a family, you can't find enough time to day trade, or you just simply prefer to hold positions for a lot longer because it's less stressful, gives you more time to go do things besides sit behind a computer, that's exactly what we do inside of the Trading Initiative. I highly encourage you to check us out. We work with guys all over the world that are interested in the markets but just don't have enough time to dedicate to day trading. We teach you our specific trading system and how to be successful in the market. You can check us out by clicking in the link in the About Me section. It gives you all of the information. And if you have any questions, feel free to leave comments below. I'll catch you in the next video.